This is the story of a man who started off playing poker as a teenager and went on to manage billions on Wall Street.
Steve Cohen.
Steve Cohen.
Steve Cohen.
Steve Cohen.
Steve Cohen built one of the largest hedge funds ever seen, but his career took a sharp turn when he faced one of the biggest insider trading scandals in financial history. Against all odds, he made a return to the top. Today, we're looking at how Steve Cohen climbed to the peak of Wall Street, fell from grace, and found his way back. Steve Cohen grew up in Great Neck, Long Island, in a middle-class family where his father worked as a dress manufacturer and his mother was a homemaker. Although not wealthy, Cohen developed a strong work ethic early on. His fascination with risk and strategy began as a teenager, playing poker and learning to navigate high-pressure situations. This experience sharpened his ability to handle risk and make calculated decisions, skills that would later become crucial in his rise to the top of Wall Street through his aggressive and successful trading strategies. As a high schooler in the 1970s, Cohen spent his free time playing poker while his friends focused on school. It wasn't just a hobby for him. Poker taught him how to read situations, weigh risks, and understand when to make a move. By the time Cohen went to Wharton, he was already applying what he had learned to the financial markets. His poker skills translated well into trading, where timing and instinct play a big role. For Cohen, poker wasn't just a game. It was practice for a much bigger stage. After graduating from Wharton in the late 1970s, Cohen joined Gruntal Co, a smaller brokerage firm based near Wall Street. It wasn't one of the big names in finance, but it gave Cohen a chance to show what he could do. On his very first day, Cohen made an $8,000 profit, a considerable amount for 1978. His early success was a sign of what was to come. Over time, Cohen became known for his ability to read the tape, predicting stock movements by observing how trades were flowing in and out. His sharp instincts quickly set him apart from others at the firm. By the early 1990s, Cohen knew he had outgrown Gruntal. In 1992, he founded SAC Capital Advisors, starting with $25 million, which included $10 million of his own money. SAC was different from other hedge funds. Cohen's approach was aggressive and fast-paced. He made big trades, moved in and out of stocks quickly, and wasn't afraid to take on risk.
It was a lot less crowded the hedge fund industry 20 years ago, and I started in 1992. There was a bull market from 1992 to the year 2000. The S&P was up almost every year, 20%, so it was incredibly easy.
That strategy paid off. SAC started generating huge returns, averaging around 30% a year. By the early 2000s, SAC Capital was managing over $14 billion, and Cohen's personal wealth had grown to approximately $8 billion. SAC had become one of the most powerful hedge funds on Wall Street. However, as SAC Capital's success grew, so did the scrutiny.
Steve Cohen has long been federal investigators' prime target. The 57-year-old billionaire hedge fund owner is one of the wealthiest people in the world.
Cohen's firm became known for its ability to gain an edge in the market, essentially getting access to valuable information before others did. But the line between legal and illegal was often blurred. Hedge funds like SAC began to rely on non-public information to gain that edge, and the SEC started to take notice. The agency launched an investigation into insider trading at SAC and other hedge funds. After years of looking into SAC's trades, the SEC charged the firm with insider trading in 2013. SAC paid a record-breaking $1.8 billion fine, the largest in history for insider trading.
SAC Capital has agreed to pay $1.8 billion.
Cohen himself avoided criminal charges, but was banned from managing outside money until 2018. One of the most significant cases that contributed to SAC's downfall involved a portfolio manager at the firm, Mathew Martoma. In 2008, Martoma obtained confidential information from Dr. Sidney Gilman, a doctor involved in Alzheimer's drug trials for Elan and Wyeth. Knowing that the trial results were disappointing, SAC sold off its holdings in these companies before the information became public. This move allowed SAC to make a $276 million profit by shorting the stocks. Martoma was later convicted of insider trading and sentenced to prison. While Cohen managed to avoid direct charges, the SEC accused him of failing to supervise his employees properly.
The SEC didn't formally charge Cohen with insider trading, opting instead to file an administrative action against him, accusing him of failing to supervise his employees properly.
Steve Cohen, now unshackled by the SEC after being suspended for 2 years from the hedge fund industry.
Despite the scandal and the ban from managing outside money, Cohen wasn't done yet. In 2014, he launched Point72 Asset Management, a family office that handled his personal wealth. With $10 billion under management, Cohen was still very much a part of the financial world.
Steve Cohen's Point72 is closing to new money next month. That firm raising $10 billion since Mr. Cohen was able to return to managing other people's money again.
By 2018, Steve Cohen's ban on managing outside money was lifted, allowing Point72 Asset Management to reopen to external investors. The firm quickly expanded, reaching $20 billion in assets by 2021. By early 2024, Point72 had further grown its assets under management to approximately $32.3 billion, achieving a new high. Cohen himself was reported to have a substantial stake in the total assets managed by the firm. Cohen's comeback was impressive, but the financial world had changed. The rise of retail traders, driven by platforms like Reddit, created new challenges for established hedge funds. The GameStop short squeeze in early 2021 shook the entire financial world, and Cohen's firm was deeply involved. One of Cohen's major investments was in Melvin Capital, a hedge fund that was betting against GameStop by shorting the stock. When retail investors on Reddit's Wall Street bets drove up GameStop's stock price, Melvin Capital lost over 50% of its investments. To keep the firm afloat, Cohen and Citadel injected $2.75 billion into Melvin Capital. The GameStop incident revealed a shift in the market, where retail investors, armed with social media and trading platforms, could disrupt even the most powerful hedge funds. Stephen Cohen's ambitions go beyond finance. In 2020, he bought the New York Mets for $2.4 billion, realizing a dream he'd had for years.
Uncle Steve purchased the club from the longtime owners, the Wilpons, for a record price of $2.4 billion.
While his financial career has been marked by both incredible success and serious controversy, Cohen has built a legacy that extends beyond Wall Street. He is one of the most prominent collectors of modern art, and his charitable donations are well known.
Do you like talking more about markets or talking about art?
Well, I always say that, if I go out with somebody in business and they happen to be a collector, we spend the first 30 minutes on art, then we get to business.
Although his name will always be tied to the insider trading scandal, Cohen has proven to be a resilient figure, constantly finding new ways to make an impact. Steve Cohen's career has been a dynamic journey filled with both triumphs and challenges. Rising from modest origins to the pinnacle of the hedge fund industry, he has navigated through spectacular achievements and notable setbacks. Whether seen as a representation of Wall Street's complexities or as a resilient entrepreneur, Cohen's influence on the financial landscape is undeniable. His story continues to unfold, not just in finance but also in the world of sports, with his ownership of the Mets. Stephen Cohen remains a formidable presence, shaping the future in multiple arenas. Thanks for watching. If you found this video insightful, make sure to like, subscribe, and hit the notification bell. Let us know in the comments, Do you think Stephen Cohen should be remembered as a villain or a financial genius?